So today I'm going to tell you about the biggest hole in your financial plan that you're probably not even aware of. Whoa. If you think about it, each day we get up, go to work, try and put a bit of money aside for the future, but there's an area that most don't talk about. In fact, if you watch most finance YouTube channels, next to no one is talking about this. There's something that if you don't cover can make all your efforts to invest and save blow up in smoke. Let me show you. This is a cash flow of your life. You're doing everything right. You're spending less than you earn, you're putting some money aside into emergency savings and some investments as well. The problem is, it's all built around the most valuable asset you have, which isn't in the model. It's you. You are what keeps this in the green. That ability to continue to save, to continue to invest, to continue to meet your bills is all based around the fact that you can continue to work and you are driving the increase in this model. The fact that your income exceeds your expenditure. So unless you're about to retire, your ability to earn is probably the biggest thing on the balance sheet. So have you ever thought what problems that might cause you if you lost that income? But wait, you might be thinking, isn't there support for people who are ill? Well, possibly. So you may have sick pay or some support through your employer, and you should definitely check that. But if you don't, then you could be leaning on support from the government. Depending on what happens to you, there can be a range of benefits, but one of the main ones is statutory sick pay, which is £96.35 per week. So let's just think about how much that is. Do you really think you could keep your life going on that? But wait a second, look, I know you're thinking, I hear what you're saying, but honestly, how likely is this will ever happen? I mean, come on, really? Well, the honest answer is way more likely than you'd like to think. If you have a man and a woman who are 35 working until 65 and they're non-smokers, an 8% chance one of them dies before 65, a 23% chance that one of them suffers a serious illness, a 52% chance that one of them is off for more than 2 months, or a 59% chance that one of those things happens. Can I just address that talking about such a grim topic, let's be honest, even me mentioning this to you in your gut is probably giving you sort of these vibes. The point is, just remember that it's better to plan and protect against these things than to have them happen to you. My job as a financial planner is to have difficult conversations because trust me, the uncomfortable chat is way better than the harsh reality if you're unprepared. So that's all pretty sobering. What can you do about it? Well, let's go over the steps to sort this. In 2021, the median salary is around £31,000 per year. That's roughly £2,062 per month after tax. So let's imagine you stopped work and you weren't able to work again and all you got was statutory sick pay at around £417 per month. The hole in your finances, if we assumed you planned on working till 65 and couldn't get back to work, would be, well, if you're unable to work from 40, it would be £493,500. If you're unable to work from 30, it would be £690,900. And if you're unable to work from 20, it would be almost over £900,000. Can you see, even on a basic salary, how important you are as an asset? The fact is, look, if you're watching a finance channel, it means that you're probably above the median salary. And this doesn't even factor in wage growth, the fact that you're going to earn more going forward. The thing is, protecting yourself doesn't just protect your quality of life. It also protects your savings, your investments, and if your income stops, what is the first thing that you're going to dip into? This is why those finance YouTubers, I believe, are missing a trick by not mentioning this. Because unless you've got savings in the hundreds of thousands, it's really difficult to properly self-insure. And while it may not happen to you, do you really want to take that risk? Instead of letting an insurer do that across many other people. Okay, so what steps should you take to work this all out? Well, step one is calculate your human capital. This simply is, what are you earning? How do you expect that to increase and for how long for? The thing is, perfect is the enemy of the good here. And people fret too much, in my view, about not getting the exact cover to the pound. It's impossible because life changes. So once we've got this, we can then step two, split that category between being ill and passing away. Because remember, passing away and being unable to work are very different things. If you've got life insurance, that's not going to pay out if you can't work. So you need to make sure you have this different category set up. So step 3 is minus any protections you have in place. So you might already have something in place, and there's no point getting more cover than you need. And it's also completely fair to use cover that you've got through work, for example, sick pay, death in service, or income protection. Hopefully you'll have a mixture within your workplace. But just bear in mind that when doing this, if you develop a health issue, which makes insurance difficult to get privately, and you move jobs, you could find it that you don't have cover in the new role just because they don't offer it, and that you can't get private health insurance or income protection or whatever. So you need to consider this, and it's not uncommon for people to have a private policy running alongside any cover they've got at work just to factor in at this risk. So if you haven't guessed, I'm a financial planner, and financial planners earn a living in helping clients sort their finances. Whether that's through an investment, estate planning, or if the client does protect against disaster for themselves and their family. So if that happens, I might get paid. The question is this the reason that I'm mentioning this and others aren't? Look, I do get it, but actually I don't think that is the case here. I actually not even sure how many people will watch this video because, let's be honest, we don't like thinking about it. Or why don't you prove me wrong and hit the like button, you little contrarian? But just remember, whether you agree or disagree, it doesn't change anything about the risk. Only your actions can do that. So making a couple of steps could end up being the best financial decision you ever make. Or, of course, you could live a long and healthy life and lose out. Okay, but you might be thinking, all right, George, well, look, I still don't know what to get. I mean, what do I do now? How do I get this all in place? Look, here's where we talk about the 3 pillars of protection. Pillar 1 is income protection. This is the first and most misunderstood and underused hole in people's financial plan. That's not just me saying this. In fact, consumer group Which said that income protection is the one policy that every working adult should consider. This is sometimes confused with critical illness insurance, and it shouldn't be. Critical illness pays out on a diagnosis of, you guessed it, critical illness, but an income protection can cover any illness that you're signed off for. It pays out on a monthly basis until you can work again. So you can actually get cover all the way to retirement. Shorter policies are available, but please be careful with that. If you think about it, you're covering a long-term risk of being unable to work. You don't want that to happen and then be screwed after a 3 to 5 year period or whatever because of the length of your policy. There'll be a deferred period, the period before you have to be off before the policy kicks in. Normally it makes sense to align this to your employer's sick pay or the amount that you're comfortable living off savings. Longer the deferral period, the cheaper the policy will be. The downside is you can't cover all your income. It's normally only about 65% of your earnings, but a policy you pay for yourself is paid to you tax-free if it pays out. So actually the difference after tax isn't that massive. Okay, so pillar 2 is life cover. Simple enough, pays out if you die. You can get it in a lump sum or also in what's called family income benefit, which pays out the life cover in a guaranteed monthly installments. So it's more like income for the family, hence the name. So one thing that's important to consider is if it should be written in trust. If it's written in trust, it'll generally be outside of your estate for inheritance tax because you don't want it paid into your estate when you die and then potentially the taxman taking 40%. However, always check this and get advice specific to you. And pillar 3 is critical illness, often seen as an add-on, but probably unfairly. Critical illness covers and helps support you and your loved ones financially if you've been diagnosed with a serious condition. The conditions cover vary from provider to provider, so make sure you check carefully or get advice. Critical illness doesn't usually pay out if you pass away. This is where life insurance comes in. Why would you ever have all 3, like I do? Well, surely the income protection covers everything, right? Well, let's get into the not nice headspace and imagine you've been diagnosed with a critical illness. Your income protection will cover your main income, but you won't be better off because it can only cover a proportion. Critical illness pays out a one-off lump sum, so you can do whatever you want with that, whether that's just creating a bit more time and headspace to manage the condition, or maybe even make adaptations to the home. Okay, I know what you're thinking. What's it going to cost me? Well, probably not as much as you think. The big things to consider here if you do decide to get any cover is how much cover you'll have, how old you are, because life, your state of health, and if you have particularly bad health, you may struggle to get cover. If you need that cover to be level or decrease over time, so it might, for example, go down if there are kids leaving the house, so there's less financial dependence there, or perhaps a mortgage if that gets repaid over time. So the key thing is it probably doesn't cost anywhere near as much as you think. So £8 a month, what's that? That's a monthly subscription to a streaming service. Or £100,000 of life cover for someone in their 30s. £20 a month, like a takeaway or something. Well, that's for someone in their 30s, £1,000 of monthly income protection. £30 a month, what's that? That's kind of like going to the cinema for 2 people and getting some food and all the rest of it. So that's £75,000 of combined life and critical illness cover for someone in their 30s. So when you do get cover, you'll do what's called underwriting, and depending on your health, your age and the cover amount, that will assess the cost at that point. One thing I'll say is that if you are going to get cover, I would strongly suggest get it through someone who knows what they're doing. There are lots of areas in relation to setting this up to make sure it's right. For example, the right trust setup, choosing the right provider, or a lot of these providers have extra benefits attached which are also important to check. So look, I hope this has at least made you think. But at the end of the day, you might want to chance it. And there might be ways of funding that shortfall that maybe, I've not thought about.
Say my name.